Today's number is 20. That's the amount of times we've seen setups similar to this on both the NASDAQ and S&P 500. But what happens next for us as traders and investors? In today's video, we break down everything that you need to know right now as the market moves towards hedges and we start to see some massive options flow. Yes, bonds are back and we need to discuss what it means for all of us right now. Don't go anywhere, guys. We've got a lot to cover. See you very soon. Well, welcome back everybody to the Daily Show. My name's Tom and today we have a lot of things to discuss as always. What's going on in the macro world, tariffs, jobs numbers, etc. And are we entering into the dreaded stagflation? It looks like some market areas are starting to see those flows. So let's kick things off by talking about the tariffs, because the good news is it looks like US importers are wearing the costs for now. The bad news is it's usually temporary. And one of these problems is that this is what usually happens when it comes to drastic changes in any type of commodity product or anything else. Generally, the importer wears some of it and then sees whether it's actually going to be sustained. When they realize it is sustained, they slowly flow it through to the person that, of course, is buying that particular product or consumable. Now, in this case, why is that so important? Well, of course, it means that we, again, have not seen tariffs really flow through into the economy just yet. And as we speculate on this channel, because everybody knew it was coming, it's probably going to be anywhere from 6 to 12 months out before we really start to see significant impacts of these global tariffs. Speaking of those, we did see quite a few different changes here coming from Trump and threatening, of course, higher tariffs across the world. And we'll cover that as we start seeing it come through. But the main thing for now is really understanding this current sell-off and whether it's the real deal or it's more of just a blip on the horizon of what has been a very big bull market. Well, I saw this chart actually, and I thought this was absolutely wild. Robots are pulling the economy along this year. Now, as you guys know, we often look for what we call CapEx or CAPEX spending. Now, why we look for that is because we want to make sure that businesses are reinvesting in themselves and reinvesting in the economy, and that tends to be what we call long tail gains. So effectively that means that if you're investing in a stock, you're going to be wanting to hold that for longer because, of course, they're making sure that they're future-proofed. Now, the good news is we have been seeing this spending going up this year. The bad news is it's only in tech stocks. And this is why AI tech investments is on the rise and the American consumer spending is dropping pretty drastically. Look at the difference here from 2024 to 2025. And while we don't have the numbers, there is obviously a width here in terms of the difference between the AI spend and the consumer spending. And it's more along the lines of what we expect, which is going to be most likely more people losing their jobs over the next 12 months to 18 months, and the Fed having to step in and most likely do a bunch of rate cuts. Now, why could this also be showing up in market cycles? Well, we've only seen this a couple of times before. According to Drury and Kimmer, we've actually seen this type of concentration happen in only really two main markets. The Nifty 50 during the 1970s and, of course, the tech bubble during the 98, 99, 2000 period. Now, you guys know we've been using these kind of analogies, particularly this one over here, to the current generation of AI. Is this technology real? Absolutely. Is this technology going to change the world? Of course it is. But is this technology ready yet? Well, the market is obviously pricing like it is. Some of you guys would say, yes, Tom, it's here. We're seeing it play out all over the place. But generally speaking, remember, there tends to be a long curve of adoption. So you've got to remember when we get to these types of concentrations, which have arguably been going on now for quite a few years, this starts to make you question whether you're in a bubble. And this is important as an investor more so than a trader. Now, let's just quickly read this number, 35%. That's the number of stocks that are actually beating the market over this current run, and we've hit 84%, which, as you know, is starting to get up there with all of the great bull runs. If you get up to about 100+%, then you're equaling into some significant territory, and this, of course, happened since 2022. So you've got to remember, when you stack it on top of the global financial crisis to now, you start to get a very big number indeed. This is a very important chart, and of course, we'll continue to focus on it. We have a concentrated market where 10 stocks make up like 36 to 37% of the total market. And remember, if the tech stocks were not declassified and changed in terms of their sectors, we would have actually been up with about 42 to 43% of the market being made up of just tech itself. That is the most concentrated market we've ever seen in history. Let's take a look here at insiders buying, because it's drying up. You know that insiders bought big because, of course, we reported on it during the dip of what we saw in April. Now, why were they buying the dip? Well, it was mostly tech insiders, and you guys know why. It was AI. They were spending big, and they saw a big chance of one of the big bull reads that we've been talking about, which is basically lowering the amount of employees they have, one of their biggest expenses, and using AI to replace them. Now, they've already started to do that, but it's turned out that since tariffs, it looks like insiders are starting to dry up. And that's not a reason to go out and run away, but it certainly is a reason to start questioning why they're doing that. Do they think cheaper prices on the horizon, or is there something greater going on? Well, let's take a look at the funds rate. So as you guys know, one of the members of the community always creates this for me, so that's really awesome. We share it over on our X account, links in the description down below. And what this is showing you is at the latest reads, we're seeing a whole bunch of rate cuts starting to get priced in. It's expected that by 2026, near the end, we'll be at around 3% for the federal funds rate. And basically, the reason why that is because the economy is starting to weaken. Remember, the GDP number came out only 2 weeks ago, and it looked good on the surface until you looked into the fact that there were very weak numbers underneath the hood actually in the GDP. It was being again driven by mostly AI spend and some stuff to do with tariffs. Let's now have a talk about 30-year mortgages. The good news if you're a home buyer is, I guess, 30-year mortgages are coming down. So that means that, of course, we're seeing a big drop off here. And in the technical world, we would look at this as a break of support. So what's that telling us? It's probably telling us that the trend right now is for yields to drop. And that's probably going to be sustained. It's highly likely now that because we've seen a series of lower highs coming through this, that we are now in a breakout to the downside. And the question then becomes, are we going to see stagflation, where effectively inflation returns due to tariffs and other things, and it forces the Fed not to be able to cut? Remember, we do have one of those dichotomies similar to 1980s, where we have kind of the administration, being the White House, saying we want lots of cuts, and the Fed saying we're scared of the tariffs, we don't know how they're going to affect the economy. It's going to be a really tough one. Even so, though, we'd have to expect now a couple of cuts from the Fed. Let's now go through global positioning. This is a cool chart here, and it basically shows us CTA positioning. Now, remember about 2-3 weeks ago, we talked about how CTAs had to buy. Well, they did. They actually purchased up big time, and they've now purchased to usually where they become overbought. So basically, this means that according to the latest data here from Goldman Sachs, in most cases, they're going to be globally selling in terms of the CTAs, and if the tape does start to go down, they're going to sell pretty big time. So do remember here, according to the next 1 month tape, if we get sell-offs in August, and of course if we continue to see sell-offs this week and a fall through a very key level, then that's going to probably lead into some pretty big moves. And the CTAs are going to reposition to the downside, which seems absolutely ridiculous considering they're barely up on their positions. If not, they're actually down now since we saw these sells. Now, here's the chart that I shared over on our X account, and it's got to do with the weekly closes. So a lot of you guys very astutely sent me messages, and I agree with you, and I already had it there, which was that we started to see some engulfing style candles. Now, you can get into me about, whether this is a technical or what, but what has happened here is we've basically seen a bigger red candle than, of course, the previous green candle. And when you get this, of course, it does show you that there is weakness potentially in the market. Now, the key here is that it's happening at an all-time high. Now, I've marked mostly all-time high ones, or at least ones that came off good runs. And you can see here that about 6 of the last 8 reads were actually ended up with another bearish kind of week. So what that meant is that even if we recovered, which is a very normal thing to do and is what we suggested and thought would happen during the next sessions, we generally then see further selling off. And the reason why we get that is because, of course, the market is due for a pullback. Now, how much worse could it get? Well, a lot of people always look for technical confirmation of these patterns. So they say, okay, yes, I see weakness. I'm looking for a new low. And if a new low comes through, it could create what we call a little bit of a cascade or negative gamma effect, and that could push us into the all-important 6,000. Now let's back that up with some further statistics. Number one, we fell underneath the S&P 500 20-day moving average. When that's happened after a big streak, the market tends to take a breather. As you can see here, a few days later, yes, markets do tend to be down across the board. And when we get reversals like this and we go back through all of history, you can see here, according to the latest Nautilus research data, that actually, yes, the after signal event is down across the board generally over the next couple of weeks to the next month. So what that's telling us is that volatility is probably set to stay. Remember, the set of the good bull market, guys, is that you see ups and you see low volatility. When volatility starts to appear, it can often create a pit, which is basically a lot of sideways action, or even a more considerable kind of sell-off between the 5 to 10% style variety. And you won't be able to see this chart on YouTube, but what this is it's again one we shared over on X account, and basically it shows you all of the different narratives. So if you took all of the major ones that are correlating most closely with the current market, what would generally happen around this peak is we would see some weakness come into the market and it would start to sell off a little bit. Now, why is that important? Well, of course, it really matches up with a lot of the data we talked about. And the good news is that the data isn't all bad. It basically is telling us that even if we do sell off and correlate, that generally the market does end up picking up after that due to stimulus or other reasons. And of course, that this is very normal in second term post-election years. August is weak across the board, as we know. August and September tend to be really bad months. And of course, August, especially recently, has been one of those ones known for random events. Now, if you have a look here, according to Ryan Detrick's latest data, there are all sorts of weird events that happen in August that tend to say big sell-offs. But even just recently, as we mentioned, 2024, we saw the yen carry trade unwind. We obviously saw that smash semiconductors, and it took over pretty much 12 months for the semiconductors to recover and make new highs. So things can happen. August tends to be the period of time, but the good news is the liquidity is still there. So effectively, we are still seeing covert ops, effectively QE. And the Federal Reserve, the central banks around the world, they're still pushing through liquidity. And we kind of expect this to continue into the end of the year, but for 2026 to potentially become very dicey. Remember, just over the next couple of months, we have huge amounts of treasuries expiring as well. So it's going to be a lot of pressure on the financial system, not to mention everything else that we've been seeing. Now, what about the earnings? Well, Palantir smashed it. Let's just quickly read a couple of numbers here. EPS beat by 2 cents. Net dollar retention up 128%. Raises full year outlook to 4.15 billion. And of course, revenue was up 48%. So what are we seeing? Anything that's related to the administration or anything that's pretty much related to tech at the moment and has AI or anything like that in it is smashing it. And they've obviously become lean, mean fighting machines. So from the world of earnings, from the world of, I guess, options, where are the levels that we need to be watching? Well, we'll bring this up a little bit later, but 6,300 has become a major zone. And this is going to be a very important level over the next 24 hours as we closed around here. You guys can see puts everywhere. So if the market continues to sell, then takes the low of the weekly close, then that's going to be one of those potential catalyst style events. And what could be the catalyst? Well, it can be earnings. AMD just came out with earnings, and I'm sure a lot of you guys have looked at it. It was okay, but the data center was down again. So of course, you know, the market's going to be taking that into its stride as well and saying, well, wait a second, what's going on here? And then we've got so many more potential companies here, a lot of them having to do with the American consumer as well, which may be weakening. Specifically, take a look at Shop over the next 24 hours. Let's see how that goes. And that is happening Wednesday before the open, so that's going to be a big one. These are the expected moves, plus minus 12 on Shop. TTD is going to be plus minus 13.5. Some big stuff coming. So let's now go over to the S&P 500. Did it do what you would expect it to do? The simple answer is yes. We expected a rally. It did do so. You could even argue that this is a small island reversal to the upside if you're a big bull. And of course, if you're a big bull, you're going to want 6,200 to hold. You do not want it underneath that level, because if that happens, it creates potential cascades. As you guys can also see, what do? We filled the gap. So again, for the bears, this is pretty good because we managed to pull back up, fill the gap, come back to a level that makes sense, and then see a bit of a sell-off into the end of the day. Here are the high and low options levels for today, but as we've been talking about, this 6,000 keeps coming up in my mind. There's a few reasons. Weekly 20 moving average, mean reversion in general, which has happened several times during any good bull run, and it tends to be where the street likes to activate stuff. We've also got a lot of big demand around that area. So it's pretty much, are we going to hold here? and bounce? Or are we going to fall through and likely move to the next level of equilibrium, which is going to be around that 6,000 level? And I asked you guys in the comments, and a lot of you do believe 6,000 is coming. But of course, as the problem with all of that is that sometimes it does end up becoming wishful thinking. A lot of you guys want cheaper prices, then it goes down to those prices, and then you can't pull the trigger because you're like, oh, well, there's a reason. There's always a reason, guys. The question is, are you going to be able to, of course, find that abundance mindset? Let's now move over to the US 500, and you guys can see here, 6,200 is the clear level. Why? Because if it gets underneath there, we've broken the supports on the left-hand side. We've basically started to instigate really the move down, and there's not much holding it here. I mean, yes, it can bounce there, but statistically it wouldn't be very likely to bounce off those levels. We'll do more work into the weekend, but yeah, one of the big things is that kind of key level. Now, I do apologize if you're hearing some kind of beeping in the background. There's nothing I can do about it. And I will also let you guys know that usually, if you're new to this channel, we do produce daily videos for the market. We've done that for years and years and years. I am technically on holiday, so that's why the audio is a little bit different and stuff. But I have to create these videos for you because it's a thing, guys. I think you can remember this. If I go on holiday, which is very rare, the market falls. It's always the way. It's always the way. But what I want to mention here was that we came back to the 61.8 fib. Now this happened on the NASDAQ as well, so this is exactly what you would want to see if you're actually a bear. And a lot of people don't understand. It doesn't just sell. Often it will sell, it will rally, it'll come back to a key point, and then it will make a decision. Will it go higher? If it does, well, then we could be looking at new all-time high. And if it sells in this area here, then often it will continue to fall down to 6,200, and then it will make a decision. So I think 62 is important. 63 over the next 24 hours is important. You can see here the puts everywhere, and there is a clear fight between calls and puts. So if the market does choose to break either way, it could be quite ferocious. So be ready for that. You can also see as well, people are stacking puts everywhere, which always has me thinking, oh, is the market going to just keep rallying up? But this time I think it may be able to sell. But look at all these puts. My goodness, people are just absolutely stacking. They're ready for seeing some bear action. It has to get through those areas though to trigger anything. On Tesla, 300 and 320, 315, very sandwiched between price. And of course we know Nvidia is kind of the same thing. 175, 180, 175, 180. Tons of calls around there, and it's doing okay. Now let's lead into our, of course, lead indicators. First up, yields dropped. We know this. We can see a little bit of a bounce here in the shorter term yields, but in general, the market is saying to stay, we need cuts because maybe the macro side is not as good as we thought it was. And of course, we can see here that when you're taking a look at one of our favorite leads, it did it, guys. It broke the double bottom and it said, you know what, there's some risk here. And that's, I think, important to look at. Now, it doesn't mean, oh, we're going to sell, but it's been pretty reliable when it sparks up that it does usually start to kind of kick off bigger things. You can kind of see here what happened. This was back in the March period. Obviously, we ended up escalating quite a lot since then. And this is a mixture of those tariff on, tariff off kind of situations and all sorts of things. So did we double bottom? Yes. Did we break up? Yes. Will I be using this as a read? Of course, I always do. So it's like one of those stacks, but you can't write home and say anything's guaranteed. Nothing is. Dollar index, it's sitting firm after hitting its first target. Again, it could be going towards 101.60. It does have that inverse head and shoulders that's sitting on that kind of key level here. But generally speaking, not too many new reads for dollar. Remember, the trend is overall down. The short term was up, which we've been talking about for the last couple of weeks. And so far, I'd call it almost very neutral after that jobs number, because we do need cuts now. Otherwise, the markets could start really rolling over. Semiconductors versus SPY. You guys know I'm watching this. Have we seen a break? No. So technically, for the investor, it still looks pretty good in markets. And the old defensive watch. No breakups for staples. No breakups for healthcare over the last 24 hours. So realistically, again, no reads there. Now, what is happening though is one of the old stagflation positions is starting to rise up. Silver, gold. So gold broke through the bull zone. We spoke about that. So far, so good. I'm thinking it might be going for a break here, guys. And if it does go past 34.50, then of course 4,000 to 4,200 become the next levels. We'll update that very soon. Silver's also breaking up. It's got through the first zone, hasn't got through 38.40 yet, or 37. But if it does, again, looking a bit better. And you can see here coming off a very nice hit, which quite a few members of our community were liking. I really liked it in here. It hit a very good level. So let's see whether it actually does bounce and continue on. And long term, we're looking for, well, we're always looking for 42, 43, but I'm starting to think we need to upgrade it, one of those things, especially with these jobs numbers and potential stagflation. US oil, yeah, it's whatever. It's gone up, it broke through. Some people, of course, would be bullish here. The problem with oil is it's so geopolitical, it's so tough. So it's come back down to this level. It's so neutral looking. If it breaks low, of course, it's weak. If it starts to bounce back up, then we could really see movements on it. But yeah, oil's up, down, and all around at this stage. And in some ways, Tesla is so neutral, it's almost like watching paint dry. 2 dojis, actually 3 dojis in many ways. It doesn't know which direction it wants to go to yet. The German results for selling cars was not very good, but at the same time, the stock doesn't care. It's just sitting there waiting for its next big catalyst move. And I think that's going to be an options move driven by the markets. Nvidia, what's happening? Big series of higher highs, higher lows, no lower low yet. So we're looking for that. It doesn't happen yet, so there's no reason to really be concerned. And when we take a look at things like the Russell 2K, it actually came back pretty strongly the last 24 hours. Bounced off pretty hard. Didn't see the sell that the rest of the market got. So again, some movement there in the Russell. But the big one was the NASDAQ. Went up, hit into a good fib, sold off. And of course, this one got hit harder, which means that you really have to watch the NASDAQ almost the most. Key level to watch is going to be 22,680-ish. If we break below there, then what you're doing is just confirming that we might be moving down to these levels. And that would be the garden variety of pullbacks, the normal kind of pullback that you would expect. I know 9% sounds like a lot, but that's probably only about 6 and a bit on the S&P. In the crypto world, it's the same kind of thing. You can see here, Ethereum comes up, Ethereum goes down. I didn't include it in this video but I did get the data for it. It looks like outflows have come through over the last week, so we'll update that soon. And you can see here, we actually have changed trend on things like the daily time frame to the bearish side, and that's the first time. Now, I would say are both trends still up on the weekly, monthly? The answer is yes. So generally speaking, the investor will still be bullish, but I could see why small time frame traders would be trying to short that area. And Bitcoin didn't recover as much as Ethereum, you can see here. So could it get down? It certainly could, and I'm looking specifically at this 108 area. So I'd like to see 108 and see how it performs around that zone. And it's very normal for markets to do this type of thing. So yeah, Bitcoin, Ethereum losing a little bit of the heater, but in general, I still think fairly long on the bigger time frames. Guys, if you enjoyed today's video, please remember to subscribe and smash that like button. Check out our courses as well if you're interested in finding out more about how to replicate some of these trades. There has been quite a few good trades out there recently. And if you're interested as well, follow us over on X and follow me on LinkedIn. I do post there pretty regularly. Thank you so much. We'll see you in the next one. Bye for now.